£18.40. That is what 1 week of your state pension record cost to buy back this year. Last year it was £17.75. The year before that, £17.45. So hold two things in your head at once, because this is the whole video in a sentence. That price goes up every April. And every April, one entire year drops off the end of what you're even allowed to buy, and it never comes back. The window is closing and the price is rising. At the same time, every single April, and a single missing year, 1 out of the 35 you need, is worth about £359 a year, every year for the rest of your life. Over a normal retirement, that is more than £7,000. The next year falls off on the 5th of April 2027. Nobody is going to write to you about it. The Department for Work and Pensions won't. HMRC won't. Your old employer certainly won't. Now, I know there are other videos about this, and most of them tell you the same thing. Buy your missing years. And for some of you, that is flatly the wrong advice. There are people who would be handing over £957 for something that adds nothing whatsoever to their pension, and nobody tells them that either. There are also years you can get for absolutely nothing that almost nobody claims. Both of those are in here, and that is why I'd stay with this one rather than going elsewhere. Right, I'm Julian. I've spent years buried in this one subject. The state pension, national insurance, all the paperwork most people never read. I know where the traps are because I've watched the same ones catch people again and again. Sensible people in their 50s and 60s who thought they had one simple question about their pension and found out they were on course to be paid less than they'd assumed for the next 20 years. And it's almost never because they did anything wrong. Before we go any further, if you've a friend, a brother, a neighbour anywhere in their 50s, send this to them now before you forget. This is the one where sending it early is worth more than watching it. 4 things: how your pension is actually built, and why you almost certainly have gaps, what each gap costs you, how the 6-year window works and which year is about to fall off it. And the 4th, stay for this one because it's the part that bothers me most. There is a way to have qualifying years added to your record for nothing at all. No money. Hundreds of thousands of people are entitled to it right now and haven't the faintest idea it exists. If you have ever looked after a grandchild, that section alone is worth the next quarter of an hour. Cup of tea, let's start at the beginning. Most people think of the state pension as one thing, a payment. It arrives, it's roughly what it's roughly meant to be, and that's that. It isn't one thing. It's 35 separate pieces. Under the new state pension, you need 35 qualifying years of national insurance for the full amount and 10 years minimum to get anything at all. The full amount this year is £241.30 a week, about £12,548 a year. Divide that by 35 and you get what 1 year is worth. £6.89 a week. Call it £359 a year. That's the unit. Every qualifying year on your record is a brick, and each brick is worth £359 a year for life, rising each April with the triple lock. 35 bricks, you get the lot. 31 bricks, you get 31/35ths, and the 4 missing ones aren't a rounding error. They're about £1,430 a year permanently. Now, the question I'm asked more than any other. But I worked all my life. How could I possibly have gaps? Let me show you how easily it happens, and let me give you the number that explains most of it. To earn a qualifying year through employment, your earnings have to reach something called the lower earnings limit. This year, that's £129 a week, £6,708 a year. Now think about a woman working school hours while the children were small, 2 or 3 days a week, modest pay, sensible arrangement. If her weekly earnings sat below that line, and for a great many part-time roles they did, that year does not count, not partially, at all. She worked, and the year is blank. That single threshold is behind more missing pension in this country than anything else I've come across, and there are others. You were self-employed for a stretch, and profits in a couple of years were low. Low profits can mean a year that doesn't count. You lived or worked abroad. Those years are usually blank. You took a break to care for a parent and never claimed a benefit for it because you didn't think of yourself as a carer, you thought of yourself as a daughter. You were between jobs for a year and didn't sign on because you had a bit put by and it felt like something you didn't need. Not one of those is a mistake. Every one of them can leave a hole. And here is what I want you to sit with because it comes back twice more before we finish. Your pension isn't calculated from what you did. It's calculated from what got written down. The work isn't the record. The record is the record, so that's one. Let's put money on it because a gap in your record means nothing until you see the figure. One missing year. £359 a year less for the whole of your retirement. Life expectancy at 66 runs to around 19 to 21 years, so call it 20. That's over £7,000, 3 missing years. Just over £1,000 a year less, 21,500 across a retirement, 5 missing years. And 5 is not at all unusual, particularly for women who worked part-time while raising a family. Nearly £1,800 a year less, close to £36,000. Now the other side, buying a year back costs £18.40 a week for the 52 weeks of that year. £956.80. So roughly £957 once, buys £359 a year for life. Index-linked, guaranteed by the state, with no market risk attached to it at all. Let me show you what that looks like on 2 actual lives, because the arithmetic doesn't land until you see it side by side. 2 women, same age, same sort of work, both with 31 qualifying years on the record and 4 gaps from part-time years in their 30s. Identical, in every respect that matters. The first one checks her forecast at 63. She sees the 4 gaps. She rings, she's told all 4 would count, and she pays about £3,800 to fill them. The second one never looks. Nobody tells her to. Nothing arrives in the post. From the day they both retire, the first is paid £1,430 a year more than the second. Every year. For 20 years. £28,000 on a £3,800 outlay. Same work, same life, same record. Until one of them spent an afternoon on it. And this is the part I find hard to be calm about. The department has that record. Every year of it, on a screen, in front of them. They know exactly which years are missing from your file, and they know exactly what each one would cost you between now and the end of your life. And they will not send you the letter. So that's 2. Right? Now the mechanism. You cannot simply buy any year you like. As a general rule, you can only fill gaps going back 6 tax years. That's the window, 6 years wide. Some of you will remember when it was far wider. There was a special extended window that let people fill gaps all the way back to 2006E, nearly 20 years of record. It was on the radio, it was in the papers, the phone lines were jammed for weeks. That window shut on the 5th of April, 2025. It has not reopened, and there's no indication it will. So we're back to 6. And here's the thing about a 6-year window that almost nobody thinks through. It doesn't sit still. It slides. Every 6th of April, the oldest year in it drops out of the back and becomes unbuyable. Forever. No announcement, no news item. It happens quietly at midnight, and one more brick that you could have had for £900 becomes something no amount of money will get back. Right now, the oldest year you can still fill is the 2020 to 2021 tax year. After the 5th of April 2027, it is gone, and a lot of people have a gap in exactly that year because it was an unusual year for work in this country and a great many ordinary earning patterns were interrupted. If that's you, the 5th of April 2027 is your date. Now put the 2 movements together because this is the bit that actually cost people money. The price went from £17.45 to £17.75 to £18.40. Meanwhile, the window slides shut a year at a time. So every April you wait, you are paying more for less choice, on a record that is quietly losing options at the back. Waiting has a price. It just isn't itemised anywhere. One practical note, and it's the sort of detail that catches people out. The rate that applies to an older year isn't always the current one. There are rules about which year is charged at which rate. Don't try to work it out from a website. The Future Pension Centre will give you the exact figure for each of your years, and I'll give you the number at the end. Because, and this is the second time I've said it, the record is the record. What you did doesn't enter into it, only what got written down and whether anyone ever showed you the file. So that's 3. Now, this is the section I told you to stay for. Everything so far has involved writing a cheque. This doesn't. There's a scheme running since April 2011 that hands out full qualifying years of national insurance for nothing, not discounted, free. And the people it was written for are, in my experience, almost entirely unaware of it. It's called the Specified Adult Childcare Credit. Dreadful name. Here's what it actually does. When a parent claims child benefit for a child under 12, they automatically receive a national insurance credit alongside it. That's how the system protects someone who steps back from work to raise a child. But a great many of those parents are working. They're already paying national insurance through the job. So that credit sits there attached to the claim doing absolutely nothing. It is spare. And if a grandparentee or an aunt, an uncle, a sibling, any eligible family member was looking after that child so the parent could go out to work, that spare credit can be transferred to you. A full qualifying year of national insurance for a year in which you looked after your grandchild. Let me be precise about the conditions because they matter and I don't want anyone disappointed. The child must have been under 12 during the care. You must have been over 16 and under state pension age at the time. So this is for people still on the near side of 66. The parent must actually have claimed child benefit, even if they took no money because of the high income charge, because the claim is what creates the credit. The parent must not need it themselves and they must agree because they countersign the form. And there is only one credit per child benefit claim, however many grandchildren are on it. 2 grandchildren from the same daughter is still 1 credit. There's no minimum number of hours. 1 day a week counts. School holidays count. And through the pandemic years, care given by telephone or video was allowed to count as well. Here's the part that makes me want to put this on the front page of every newspaper in the country. You can backdate it to the 6th of April 2011, 15 years. Take a realistic case. Somebody who looked after a grandchild while their daughter worked across 3 or 4 of those years and has 3 or 4 gaps on their record from part-time work decades ago. Those gaps can be filled with these credits instead of cash. 3 years is a little over £1,000 a year of extra pension, around £21,000 across a retirement, for filling in a form. At the very top end, somebody who provided care across 8 or more of those years and who has 8 matching gaps and who meets every condition in every one of those years could be looking at more than double that. That's the maximum and it needs all the conditions to line up. Most people won't be there. But 3 or 4 years is entirely ordinary, and 3 or 4 years is a great deal of money. The form is CA9176, freeongov.uk. You complete it, the parent countersigns it, it goes to HMRC. One timing quirk, you can't claim for a given tax year until after the 31st of October in the following tax year. So the most recent year waits its turn. Everything before that you can put in now. The last official figure I saw put the number of people who had ever claimed this at around 123,000 across 15 years, in a country with several million grandparents providing regular childcare. So that's 4. And that gap between who's entitled and who's claimed is the clearest illustration I know of how this whole thing works. Now I want to slow right down, because if I stopped there I'd have done you a disservice. Buying back national insurance years is not right for everybody. There are several situations where handing over £957 achieves precisely nothing, and I'd far rather you heard them from me than found out afterwards. First, if you already have 35 qualifying years, buying more adds nothing at all. The pension is capped, extra bricks don't fit. Second, if you're some years from state pension age and still working, you may well fill those gaps simply by carrying on. Don't pay for a year you're going to earn anyway. Third, and this one genuinely surprises people, you may find your forecast shows less than the full amount even with 35 years on the record. That is usually contracting out. If you were in a workplace scheme years ago that paid reduced national insurance in exchange for building up its own pension, there's a fixed adjustment applied. It has a name on your paperwork, COPE, the contracted out pension equivalent, and it does not go away when you buy a year. Years added after 2016 can still increase what you get, but the picture is more complicated, and it is exactly the sort of thing to have someone check rather than guess at. Fourth, before you buy anything, see whether you can get the year free. The childcare credit we've just been through. Carer's credit, if you look after someone for 20 hours a week or more. Credits that come automatically with certain benefits. Free beats £957 every time. Fifth, if you expect to be on pension credit in retirement, a higher state pension can be partly offset against it. And the sums come out differently. Not always, but differently enough to ask before you pay. And now let me give you the figure that makes this worth the afternoon for the people it does apply to. £957 in, £359 a year out. That's a break-even of about 2 years and 8 months. If you retire at 66, you are back in profit before your 69th birthday. And every year after that, for as long as you live, is pure gain, rising each April with the triple lock. I have spent a long time looking at financial arrangements of one sort or another, and there is very little in the entire British system that does that. Not a savings account, not an annuity, nothing. It's simply sitting there unadvertised behind a phone number most people have never dialed. So, 4 things. 35 bricks make a full pension, and the lower earnings limit means you can work a year and still not get one. Each brick is worth £359 a year for life, the difference between 2 identical women being £28,000. A window 6 years wide that slides shut every April while the price goes up. And years you may be able to have for nothing, backdated to 2011 if you've ever looked after a grandchild. And the thread running through all 4 is the same thing I've now said twice. Your pension is not built from what you did. It's built from what got written down. The file exists. It is complete. It is accurate. It is in front of somebody on a screen right now, and the letter explaining it is never going to arrive. So you fetch it yourself. And it is genuinely one afternoon. First, get your forecast. Go to gov.uk and search Check Your State Pension. It shows your predicted pension, your state pension age, your full national insurance record year by year, and every gap in it. Free, about 10 minutes, and I'd say it's the most useful 10 minutes available to anyone over 50 in this country. If you can't get on the internet or you've no government gateway login, you can ask for a paper statement instead. That's form BR19, and the same phone number will send it out. Second, if you see gaps, ring the Future Pension Centre. 0800 731 0175. Monday to Friday, 8 in the morning to 6 in the evening. Ring at 8E. The lines get busy later. And say this, write it down if it helps. I have gaps in my national insurance record. Please can you tell me which years would actually increase my state pension and what each of those years would cost? That's the whole sentence. It puts you straight into the right conversation, and it stops you buying a year that does nothing for you. They'll tell you which years are worth it and give you an 18-digit reference number, and only then do you pay HMRC, quoting that reference. Check first, pay second, never the other way round. And third, if you've ever looked after a grandchild under 12 while their parent worked, form CA9176, free on gov.uk, backdated to 2011. Now the honest note, and I'll always give you one, I'm sharing general information here, from years spent around this system and a great many kitchen tables. I'm not a regulated financial advisor, and none of this is personal advice about your circumstances. If your situation is at all complicated, and contracting out makes a lot of situations complicated, there is free government-backed help. Pension-wise, booked through Money Helper, costs nothing and exists for precisely this. Back to where we started. £18.40, £17.45 2 years ago, £17.75 last year, £18.40 now. Next April it will be higher again, and one more year will have dropped off the back of the list. And after the 5th of April 2027, the year that goes is 2020 to 2021. The people who deal with this before that date won't be cleverer than anyone else watching. They'll simply be the ones who knew there was a date. You know now. Tell me in the comments, had you heard of the grandparents' childcare credit before today? Just yes or no. I read every one of them, and the things most of you say you'd never heard of are what become the next videos. That's genuinely how it works here. Look after yourselves.